So today we are going to go through whole life insurance policies and really what to expect with respect to the average returns on cash value. This is a question that always comes up. Individuals have whole life insurance policies and ask, what's my cash value actually growing by each year? So when it comes to the cash value of a whole life insurance policy, we have the core benefits up top. It is a safe, liquid, tax-free area to position money. So we're going to look at some actual numbers here and have a ton of fun, as I love looking at numbers. Here we go. So to set expectations properly, what a whole life insurance policy will produce, and I'm specifically focusing on the cash value and net growth rate here, what the insurance company will refer to as internal rate of return. If you request this from your agent, or if you look at an illustration, that's what you can expect to see from the terminology. 3 to 5% net internal rate of return, the net growth rate year over year. Now, the policy design is absolutely critical. If the policy is not designed properly, the policy won't produce between 3 to 5%. And we've got so many historical studies and actual data on this that really speaks to the design and actual proof of performance. But here's a nice way just to stress test a policy or identify if it's designed correctly. In the first year, when you make a payment, if it's $10,000, $100,000, $1 million per year, whatever that dollar amount is, it should typically range between 80 and 90% in the first year. If the policy is properly designed, we have this 4 to 6% rate here. That internal rate of return, the net growth rate, is based on history and actual performance. However, based on the low interest rate environment we're in right now, and with dividend rates very low and expected not to come up over the next 8 to 10 years, I'm much more comfortable stating 3 to 5% as I look at actual performance and make it a bit more conservative. Could it do better? Yes, but realistically, I'd much rather set expectations at that 3 to 5% range, but that'll be consistent if things are going very, very well in the economy or very, very poorly, and it's separate from the stock market as well, which is very nice. If it's poorly designed, we've seen most policies produce between 1 and 2%, sometimes 3%. But when I say poorly designed, what that means is if I have a high base premium relative to what I'm paying in, and if that's a bit confusing, what to look for is in the first year. When I make a payment, instead of 80 to 90% of my payment in cash value, I'd see closer to 0 to 50% or 60% in cash value in the first year. Properly designed means if I paid in 10 grand, I would see between $8,000 and $9,000 right off the bat. Now, before we look at numbers, one thing I want to touch on here is when it comes to dividend interest rates and the guaranteed rate for that matter on a whole life insurance policy, very important to draw a distinction between the gross rate and the net rate or the net internal rate of return. Here's why. Is you can Google search a company's dividend rate right now, type in on Google MassMutual 2022 dividend interest rate, and you'll see 6% pop up, which sounds fantastic. However, anytime you see a dividend interest rate from an insurance company, that is always a gross rate that is credited after the company's insurance expenses. You can expect the net internal rate of return to typically fall 1 to 2% below that. So meaning once we crunch the numbers and look at what those actual insurance expenses look like, I might see it range between 4 to 5% as far as a net internal rate of return. We're going to look at numbers here in a moment. If I have a guaranteed rate of 3%, I may see a net internal rate of return right around 2%. Now, here's something to be aware of. Guaranteed rates, depending on the company and product you select, will range between 2 and 3.75%. Again, this depends on the company and product that you select, unless you have a product that was purchased prior to 2022 and you were able to lock in the guaranteed rate of 4%. That's a bit different, and I would refer to one of our older videos for more information on that. But let's look at some numbers based on dividend rates, the current rates that is with insurance carriers, and also the guaranteed rates with different guaranteed rates associated with different products, if that makes sense. All right, so what we're gonna look at here, we've got 3 policies up here with 2 different insurance companies. On the left, you see a whole life HECV, which stands for High Early Cash Value product. That's with MassMutual. Then you see a whole life insurance, a whole life 15 pay which is a limited pay product where I can pay into it for a maximum of 15 years, and then a life paid up at 95, that's actually a Guardian product. These are all based on the dividend values, and this is a simple model of $100,000 per year for 5 years. So we've got a shorter funding duration, which will typically maximize the internal rate of return on a policy. What these percentages represent, this 6% with the first two, is that is MassMutual's present dividend rate. And then the L95, that 5.65%, is Guardian's 2021 dividend rate. At the time of shooting this video, they have not declared their 2022 rate yet. So here we go. As we look at the payment, so a high early cash value product, $100,000 goes in, 92% right off the bat. Now I've got that 6% dividend rate, but my annual internal rate of return, which only isolates what I'm earning year over year, so this is not the average IRR, but what do I see? The first year, I pay in $100,000. I have $92,000 available, which is why I have almost a negative 8% internal rate of return. It's a negative hit no matter how I slice it. This is one of the major drawbacks to whole life insurance, and one thing I always like to point out. What's the bad in addition to the good? Second year, I pay in $100K. It grows from 92 to 189. That means I paid in $100,000 and I got less than $100,000 back. That's why I see a negative internal rate of return of 1.56%. Year three, we pay in $100,000. It grows from 189 to 289 plus a few $100 there, which is why I'm positive from this point forward. And then each year it gets better and better. Now, notice where the internal rate of return tops out here. Here it's about 4.4%. And actually, as the years pass, it gets a bit stronger than that. 4.74, almost 4.75% on the annual internal rate of return. This is what I'm earning year over year with the policy. If I were to look at the average, it's almost a clean 4%. Recall that the dividend rate is 6% in this example. But it's interesting, isn't it? So that's the high early cash value product. If I look at the next guy, the 15 pay product, which I really like what MassMutual did with this product, as they lowered, or they didn't lower, they kept their PUA rider fee the same on this product, whereas the other products, they increased it. You're going to see that translate a little bit more in the guaranteed values. But here, I've got a product that really serves long-term performance. But look at the upfront cash value, $100,000 in, 86%, whereas the high early cash value, which is geared for strong early cash value, not so much long-term performance, this guy is very close to it. This is the same company. Year one, same thing with the negative IRR. Year two, same thing occurs, negative internal rate of return. Why you'll see that trend where it's negative really in the first 2 years is due to that policy design. Remember where we talked about the design being critical? To speak to policy design, money can go toward insurance premium dollars or toward PUA dollars. Premium dollars typically do not show up in cash value in the first 2 years. That's a big reason why I see it negative here right off the bat. Now, as time passes, premium dollars do come back to work for you. They show up in cash value and get better and better. But as we look at this, beginning year three, I pay in $100,000. I get the $100K back, plus almost another $4,000, which is why I'm at 1.2% in year three. That's the net growth rate. Year over year, gets better and better. What this yellow represents is when I break even. So for example, by year five, 100K times 5, I've paid in a net of $500,000, and I have 506 and change. The annual growth rate there is 2.87%. It continues to compound, a bit stronger than that high early cash value product, which is nice. Nice option there, nice two options with MassMutual to provide awareness, net internal rates of return, right? We've got that dividend rate of 6%. Even though these IRRs project different rates, that L15 will likely project, not guaranteed, but likely project greater long-term results than the high early cash value product, just based on historical performance trends, how the product is actually structured and such. But both of them, realistically, I would expect to produce between 3 to 5%. The same is true of the Guardian product. Mass and Guardian, two of the major mutual companies. One thing I'll always state, with the four major mutuals, you can literally close your eyes and pick one of them out of a hat, and it's so hard to go wrong with them. Why I mention that is their dividend rates go back and forth. When we look at the actual performance, like I can reference so many different studies where one company has outperformed the other, but they are always so close with each other and go back and forth over time. As we look at the L95 policy, year one, 100K goes in. I'm at about 83, almost 84 right off the bat. So I've got the biggest hit here in the early years. I've got the least amount of cash value. Their advantage, however, is with their PUA flexibility. It is a major advantage among the major mutual carriers, in my opinion. I can just add at leisure. Break even year 5. This is based on the present dividend rate. Internal rate of return just continues to appreciate over time. And of course, we like to track the performance year over year. When illustrations are most accurate is the year that they are run. Beginning the second year, we do need an in-force illustration, but what we've seen consistent is with new illustrations and in-force illustrations, every time we run a projection, especially with the major mutuals, I've seen this very consistent with Guardian. It always hits that projection year end, assuming I make the payment up front, and then I reference the in-force illustration and say, okay, year end, did it match up? And it does, which I really like when that happens. And it does with properly designed policies in the major mutuals. Guaranteed values, let's take a look here. So, different guaranteed rates with 3 different products. I should say 2 different guaranteed rates, but here, high early cash value, a guaranteed rate of 3%, the 15 pay, 2.5%, and the Guardian product, 3%. So different guaranteed rates, but what's so interesting about this, remember that the guaranteed rate is a gross rate. Also, this product has lower PUA fees, so lower fees, a lower rate, but lower fees as well, which is going to have an impact on the net guaranteed rate, or the actual internal rate of return. If that makes sense. You can tell I like this stuff too much. So high early cash value, 100,000 goes in, 90,000 right off the bat, almost a negative 10% hit. Look at this. So the years I'm funding, I'm in the red, and when I stop funding, I'm positive on the annual internal rate of return. Break even is year 10. Okay, that's with the high early cash value product. This is absolute worst case scenario, which it has always done better than this, but it's still fantastic to look at the guarantees in my opinion, especially if I want to see the worst case scenario. I like guarantees personally with anything. So there we go. There's the annualized internal rate of return. And again, the average IRR is not positive until year 10 because that's when I have more money than what I've paid in. The 15 pay product. Look at this. Break even is still year 10. What's really, really interesting, so I'm in the red the first 5 years, but there's a difference, especially when I look at years 4 and 5. This one's performing at a faster rate. Why is that? The common industry answer we hear is because the insurance expenses are lower. Now, I mean, yes and no. The reason why is what Mass Mutual did with 2 of their products, which are the 2 products they reduced the commission the most on as well. They reduced their PUA fees, or they didn't reduce them, they kept them where they were originally at, or they raised them with the other products. So here, you've got a higher PUA fee with only a 3% guaranteed rate. Here you don't. My point is, it helps offset the lower guarantee, and I still see strong performance, especially with a major mutual company that has always delivered well above the guaranteed values. Then we've got Guardian over here, breaking even. You know, I've always seen strong guarantees from them. Just about year 8 with a 3% guarantee is fantastic when we look at it. And there you go, the growth rate over time. Very similar to the Mass product with the same 3% guaranteed rate. So I hope you enjoyed this one. This is always a topic I like talking about. A lot of people we work with frequently have questions on it as well. If you have questions, please feel free to reach out to us anytime. Please hit the like button, subscribe for more if you enjoyed it. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.